So first of all, what market risk is? Well, market risk, also known as value at risk, can be defined as the risk related to the uncertainty of a financial institution's earnings on its trading portfolio caused by changes, particularly extreme changes in market conditions, for example, interest rates or market liquidity or market volatility more commonly. So, put simply, market risk is the risk associated with the changes in the value of a financial institution's trading portfolio for a change in the market, most commonly interest rate changes. Market risk emphasizes the risk to financial institutions that actively trade assets and liabilities rather than hold them for longer-term investments, funding, or hedging purposes. Market risk was at the heart of much of the financial damage associated with the global financial crisis. You know, signs of the significant problems in the US economy first arose in late 2000 and the first half of 2007, when home prices declined and defaults by subprime mortgage borrowers began to affect the mortgage lending industry as a whole, and then ran through other parts of the US economy. As mortgage borrowers defaulted, financial institutions that held and actively traded these mortgages and mortgage-backed securities started incurring huge losses. Conceptually, a financial institution's trading portfolio can be differentiated from its investment portfolio on the basis of time horizon and liquidity. If you can remember, we discussed this in chapter 4. The trading portfolio contains assets and liabilities and derivative contracts that can be quickly bought and sold on organized financial markets. You can see the assets and liabilities in the trading portfolio of a financial institutions. The investment portfolio, on the other hand, contains assets and liabilities that are relatively illiquid and are held for longer holding period. This is known as banking portfolio or banking book for a financial institutions. Now, income from trading activities is increasingly replacing income from the traditional financial institution activities of deposit taking and lending. The resulting earnings uncertainty or market risk can be measured over a period as short as 1 day or as long as a year. So while banking regulators have normally viewed tradable assets as those being held for horizons of less than a year, private financial institutions can take on even short-term view. In particular, financial institutions are concerned about the fluctuation in value or value at risk of their trading portfolio of assets and liabilities for periods as short as 1 day. Okay, this is known as the daily earnings at risk or DER, especially if such fluctuations pose a threat to their solvency. Okay, so in short, market risk is the risk associated with the decline in the earnings from this trading portfolio of a financial institutions. Now, when we measure market risk, we typically find out how much of our earning is at risk for a given change in, say, interest rate in the market. Now, why market risk measurement is important? Well, there are a few reasons. First of all, for example, management information. You understand that market risk measurement provides senior management with information on the risk exposure taken by financial institution traders. Management can then compare the risk exposure to the financial institution's capital resources. Measuring a market risk can also be important for setting up limits. So market risk measurement considers the market risk of traders' portfolios, which will lead to the establishment of economically logical position limits per trader in each area of trading. Then resource allocation. Market risk measurement model involves the comparison of returns to market risk in different areas of trading. which may allow the identification of areas with the greatest potential return per unit of risk into which more capital and resources can be directed by the management. And last of all, the performance evaluation. Market risk measurement can be important for performance measurement as well. So market risk measurement considers the return risk ratio of traders that I just mentioned in the previous point. That return risk ratio means how much risk adjusted return is generated. So it may allow a more rational bonus or the compensation system to be put in place for the traders. That is, those traders with the highest return may simply be the ones who have taken the largest risk. It is not clear that they should receive higher compensation than traders with lower return and lower risk exposure. So the market risk measurement can come up with a risk-adjusted return generated by each trader, which can provide a more reasonable basis for setting up their remuneration. And last of all is regulation. With the Bank for International Settlement and APRA currently regulating market risk through capital requirements, we will be discussing these points later in this chapter. Private sector benchmarks are important in it's possible that regulators will overprice some of the risk. Market risk measurement model conducted by the financial institution can be used to point to potential misallocation of resources as a result of prudential regulation. So given this importance of market risk measurement, there are several approaches or there are several models for measuring market risk. For example, risk matrix model, historic or back simulation model, and Monte Carlo simulation. In the subsequent videos, we will be discussing these models of measuring market risk exposure. Thank you very much.